All right. What is up, traders? What's up, tycoons? Super excited for today's video. Lots I want to go over with you guys. We will break down TLT as always. All right, we're going to look and we have a nice little bottoming forming here. Okay. This looks like this is in the bottoming process. All right. We've got lots of gaps all over the chart. We'll see if we do get a pullback and even fill this gap down here around the $85 range. Could it potentially turn to a cup and handle and send us back up towards that 200-day moving average? All right, we'll also take a look at TNX. All right, if you're going to be trying to trade things like TLT, you need to be paying attention to Treasury yields, and the 10-year is the most commonly looked at. Right. We'll also talk about some important things that I've stressed before when it comes to Japan and China and U.S. Treasuries. We'll take a look at Tesla on the 15-minute chart here. Looks a little bit scary, right? I'm kind of seeing a head and shoulders right here. AMAT just had a hard drop after its earnings report. All right, there's also talks of an investigation, and you can see it went from 154 at the close to 143 post-market. There's two gaps down to fill. Now, obviously, there's going to be a massive gap to the upside to end up filling, but the big question is now, will we have enough downside pressure to actually start filling some of these gaps lower? We'll take a look at Apple as well. After recently breaking its downtrend, it's pretty much gone up in a very straight line, you can see here. And ultimately, we'll see if it cracks through this trend line, where are going to be some of the key levels of support, right? It doesn't mean that it has to reverse all the way back down to zero, but we will pay attention and see if we can break this pretty much straight line up that Apple has been trading on. Right, we have this Gurgavin guy here. I thought it was really interesting that he was talking about buybacks. I think I saw this tweet like a day ago when a few days ago, okay, I was on StockTwits. So I don't have a Twitter, but you guys can follow me on StockTwits at ZachlyTrades. Elon Musk banned my Twitter. I'm not sure why, but when I reached out, they said that they will not restore my account and that I'm permanently banned now. So we'll go into this and talk about buybacks and different things like that, and why this Apple stock has still been going up, even though guidance and earnings and sales and revenue really hasn't been the best in Apple. Okay. Now, NVIDIA right here, I thought this was pretty great from the earnings whisperer. Basically is a magnet sucking up all of the other, chip stocks, all right, and the stocks in whole, all right, SOXX, the semiconductor ETF. It's got earnings coming up very, very soon. And NVIDIA has really just been the magnet, really boosting all other stocks and bringing all other stocks higher as a part of the AI frenzy. All right, we'll talk a little bit about inflation, all right, and go and take a look at the Zillow Observed Rental Index breakdown. CPI obviously was a really big catalyst for the market this week. We'll take a look at average real wages rising. We'll talk about millennial credit card delinquencies, and then we'll go into the Fed balance sheet and Fed liquidity, which is going to be pretty important, I think, for understanding the overall horizon. Okay, and go into U.S. Treasury holdings. We'll take a look at a global liquidity index here, which is going to be pretty interesting. In my opinion, something that I think you guys are going to want to pay attention to, and how that relates to gold and crypto potentially due to this global liquidity. We'll tie all of that in together we've got some charts here from Worth Charting, basically showing the unfilled gaps in the S&P 500 in red. Now, remember, these gaps, they do tend to fill about 90% of the time. The big question is when, right? And so, a lot of bears are going to tell you, look at all of the gaps down that the S&P 500 has to fill. We do have one gap up to fill. All right, that's a chart of it. And then this is an actual screenshot in a table, basically, of all of the different levels. Okay, but if we were to fill the bottom gap, that would be another 11%, almost 12% down from where we are currently. But as always, the content provided on this channel is just for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So let's go ahead and get right into it. Before we do, I started a completely free newsletter for you guys, Investment Intelligence, giving out free valuable finance content as well as free trade ideas. This is what the trade ideas will look like, breaking down, what it is that we're looking on the chart, showing you guys the chart. Okay, and lots of these trade ideas have worked out very well. All right, and they're completely free to you guys. This was a rising wedge on Stanley Black & Decker. You can see how that played out very nicely. So if you're fans of free valuable content and you want free trade ideas sent directly to your inbox, definitely sign up for that newsletter using the link in the description. You can also join the Investment Intelligence Discord. Carnival was a play that we've been looking at for a long time. And if you take a look at just some of the profits, IWM was one of the most recent trades, okay, that wasn't in the newsletter. So, if you want access to all of the different charts that I'm looking at and different things like that, feel free to join the community, join the Discord. All right. There's a link in the description for that as well. And that's where you'll get access to all of the different trade ideas. It's only a couple bucks a week, so less than a cup of coffee. And if you don't want to do that, you can just sign up for the newsletter, right? You'll still get that, content straight to your inbox for free. Now let's get into it and talk about CPI, right? CPI obviously came in favorable. Now, it wasn't really a huge dramatic shift. Okay. Really, energy had a big part to do with it. Energy is here in red, and you can see that's where things went down. This was good. Okay. Because overall, energy has a very big impact, right? We know that the Fed likes to look at core excluding food and energy, but food and energy are two things that we all need to survive. So to be excluding that, some of the two most important things we need, isn't really too relevant to, the average person, right? We see core services really still holding up. It is in a downtrend, but as you can see, that downtrend is starting to slow here. And that's basically one of the things where inflation is staying a little bit more persistent. Core goods, we saw come down, energy and food. So, when you take a look from that aspect, you can see why the market really liked the CPI report here recently and why we saw a really strong rally, just kind of supporting the thesis that, hey, the Fed is winning the inflation battle, and maybe it's time to call their bluff that, maybe we're not actually going to keep seeing higher for longer. That's a big reason that we've seen the markets rally, is because they're, anticipating Fed rate cuts. Now, this is the Zillow Observed Rental Index on a year-over-year percentage change, right? And we can see that this has come down very dramatically as well. So rents, and housing is another big important factor into CPI, and also on the average American, right? And so we can see that rent prices are actually starting to finally decrease in their rate of inflation. I know for a long period of time there, it just seemed like it was just going up nonstop and it was just getting absolutely ridiculous. So it's finally nice to see that below 4%, and kind of, looks like it's trying to baseline here right around that 3% area. Now, average real wages are rising. So you're basically looking at the real hourly compensation for all workers. And then this dotted line here is basically the trend growth rate. So we are a little bit below trend, okay, but average real wages are rising. So this is something that suggests a little bit of a stronger economy. I know it's very tough to feel, like your wages are going higher, okay, because of inflation. And so you're getting paid more money, but then everything's costing more money. But overall, the average real wages are actually going up. But that doesn't mean it's all sunshine and rainbows, right? And so even though the bulls are using this as a more bullish thesis, if we take a look, millennial credit card delinquency exceeds pre-pandemic levels, while baby boomers, Gen X, and Gen Z are at or near their 2019 averages. So basically, we're seeing delinquencies go up in credit cards. Recently I was listening to a podcast with the man who basically came up with the whole yield curve, the inverted yield curve theory, and how it predicts a recession. And he was saying that there's many other things, and how he thinks that it's pretty much certain and guaranteed that we are going to see a recession. And he was saying that one of the main leading indicators that you can look at is going to be delinquencies in credit cards and auto loan delinquencies. This is something that is ticking up, and this is one of the factors that he is saying that eventually will lead to a recession, and why the Fed needs to actually stop their higher for longer policy and start cutting a lot sooner, or he believes that they already should have been started cutting. Now, these are those unfilled gaps. So as you can see here, the lowest gap down is going to be 39.79. Let's just round it up to 39.80 on the SPX. So pretty dramatic drop from where we are now. And then up top, we do have one unfilled gap at 45.67. So all the blue ones here, those are gaps that we did have that ended up getting filled. And so again, this just re-illustrates and reiterates the point that all of these gaps eventually do get filled. It's just a matter of when, right? You can see how long it took for some of these gaps down to fill, right? This took a very long time for this gap to fill, very long time for this gap to fill. And then there's plenty of gaps that filled in a much shorter and smaller period of time. And so this could be one of those periods where these gaps down may not fill for a year, for over a year, or we could be getting to the point where we're going to see a turning point in the market and end up coming down to fill those gaps to the downside, right? Again, this is a table of them. So if we were to fill the lowest gap down around 39.80, that's basically a 12% drop from where we are right now. I've spoken to a couple bears. I know a couple bears, and they seem really set around that 3,800 price level. And so if we do come down to that 3,800 price level, we would end up seeing, those gaps down filling. Now, if we look at U.S. Treasuries, basically these are the people holding U.S. Treasuries. And what I want to highlight here is that China and Japan. Now, this data set is through June, okay, and this is the one that keeps popping up for me. So I'm not sure why it's not updated to present time, but Japan and China are the two and have been the two biggest holders and buyers basically of US Treasuries. And the reason that we've seen such a massive sell-off in TLT is because they are pulling back, right? So they've been selling US Treasuries, right, at a very at a much higher rate than they have in the past. And so when you think about it, our two biggest buyers and holders of US Treasuries are actually sellers here. You combine that with the massive amount of short positions in US Treasuries, right? We all know Bill Ackman had his huge short on the 30-year Treasury, as well as many other people. We've gone over the data in the past before. And so if you combine all of that together, you have the two biggest buyers now becoming sellers, and then you have massive shorts, all right, from traders and institutions. And then number three, which is really almost the most important factor, is we have quantitative tightening happening right now. All right, now, three out of those four things are going to remain the same. Okay. The only one, the fourth one that's really going to change, in the future that we can see is going to be the positions is going to be short positions, right? Those can change, from short to long, long to short, right? On the flip of a coin. But right now we've got quantitative tightening. The Fed, is basically right up there in that top three with the largest buyers of U.S. Treasuries, and they've been absent in the market doing quantitative tightening, right? They were doing quantitative easing, all right, and now they're doing the opposite, doing that quantitative tightening. And you've got Japan and China, the two other. So we've got the three biggest basically buyers in people essentially buying U.S. Treasuries and supporting the U.S. Treasury market. They're absent, right? And then again, we mentioned that fourth factor, those huge and large short positions in Treasuries. That's really not going to change anytime soon unless the Fed announces that they're going to be doing some type of quantitative easing again, right? So this is something that you really want to consider when you are trying to make your investments into TLT, and something you at least want to be aware about, right? Now, if you look at the Fed U.S. Treasury holdings with extra defense spending, all right, this is from Cross Border Capital. They had some interesting data that I just wanted to kind of share with you guys. But essentially, they're just saying that, the Fed is going to get back to that point where they are buying U.S. Treasuries again. And they think that it's possible that the Fed balance sheet, is basically going to go up to $10 trillion in the next 10 years. Now, this assumes that the Fed buys 1/3 of new defense debt. All right. And then you have the Federal Reserve's holding of debt held by the public here in orange. So this is just, something to think about. And basically this would introduce a lot of liquidity into the system. If you look at the Fed balance sheet and Fed liquidity, right, you have the Fed balance sheet in red and then the Fed liquidity here, essentially in orange. And you can see, they started that quantitative tightening, and slowly and surely the Fed balance sheet has been going down until we had that period in March where they bailed out the banks, and you see it just shot up dramatically, very, very quickly. And then we started going back down again, right? Very similar to what we saw with the pandemic, obviously at a much less degree, but still, it's a huge amount of money. All right. But what we're seeing here actually is, Fed liquidity is actually starting to go up, right? We have the projected QT program at $95 billion per month. And that's basically going to keep us kind of like in this area here. When you look at gold and crypto liquidity, you have global liquidity here in orange, and then you have the monetary hedges. So this is going to be like gold and crypto. You can see that these cycles typically tend to follow each other. All right. And, I thought that this was pretty interesting because if you go into the next chart, it's basically a cycle right here. And we're looking at a global liquidity 5 to 6 year cycle. And look where we're at. We're at that bottom period and heading into 2026, 2025, and 2026. We're basically supposed to see a large amount of liquidity come into the market. And so if you go back into this, this is going to be potentially bullish for gold and crypto. Okay. Gold kind of tends to go move along with the inverted treasury yields with like the inverted 10-year yield. So, if we do start to see yields come down, it's very possible that, gold and things like crypto is a big beneficiary of global liquidity. And if we start to see this come into the market, and especially, this graph here where they're basically suggesting, $10 trillion of liquidity from the debt, from the Fed rather, then that could be some really impressive gains potentially, in things like crypto and gold. Now let's go ahead and take a look at our 15-minute chart here, okay, for Tesla. Now, obviously, we got the left shoulder, head, right shoulder right here. If we were to simply basically break this neckline right here, okay, this is basically our rough neckline, okay, for the Tesla inverse head and shoulders, or just regular head and shoulders. It's very possible that we could see some type of move like this on Tesla, taking it back down to this 216 to 208 area, right? We'll definitely have to pay attention to that. Obviously, on a 15-minute time frame, we do have our 200 period moving average lining up right around with the support of about 226. So that will be an interesting area to see if we can actually make it down that far. This could be a head and shoulders, how the head and shoulders plays out as well. So I'll be watching that closely right now. We did a really good job of catching the move up on Tesla, taking some profits, not being greedy. And now we're just ultimately looking to see where it's going to go next, right? There's a gap up, there's a gap down. It's a pair of twos at the moment. If we look at AMAT, okay, we talked about this one a little bit briefly earlier. All right, a tremendous rally to the upside, pretty much a straight line, just like Apple. And now in the blink of an eye, that rally is gone. Okay. And it's pulling back already to its 50% retracement at 143.52. Below there, 140.15, 135.35. Those are going to be some strong support areas to potentially bounce at. All right, and if we break through there in our 200-day moving average, there's a huge gap down to fill right around 123. This could be somewhere, this could be the catalyst that really, sends this stock trading that lower, right? It's already down here. It's very possible it could do something like this. Right now, I'm not really going to chase this short right here, just on one day, but it's just something interesting. And this could end up spilling over into the semiconductor space and affecting the semiconductor industry. At the end of the day, NVIDIA is that powerhouse. It is that magnet that's just key, drawing all the other chip-related stocks higher. So, NVIDIA will be more important than something like AMAT, but we'll have to see if that can spill over into, some of the semiconductor industry or sector. This is Apple right here. Again, Apple, I'm going to be watching this one very closely. I mentioned in the Discord, this thing could be ready for some shorts. We'll just ultimately have to see. The trend is still your friend, right? And the trend has been a very, very strong uptrend. We are at these overbought levels, right? We haven't really been overbought since this summer. If we break this trend line, it's very possible we get a pullback, but you want to keep in mind that, if it simply just pulls back to 185 and continues the uptrend, that's a high possibility. Okay. Just because it breaks this trend doesn't mean it has to go and get a full 100% retracement and reverse all the way to the downside. It can even break this trend and end up putting in a bull flag, right? If we do something like this, where we just start to trade sideways for a little bit within this range of 185, 190, 191, and just consolidate, that's going to be bull flag consolidation, at which point we could look potentially for a breakout to the upside. So, nothing about this is screaming bearish, but it is, a potential short idea that we'll be looking at and not looking to, be overly greedy or overstay our welcome in the power horse that has been Apple. A large factor of that, if we take a look here, I was explaining to some people on StockTwits But it's pretty hard for Apple to be a mega growth company, right? I mean, yes, they are huge, and everyone, and they've been a great growth company. But what they are doing right, okay, is they're yield farming high yield short-term interest rates with their huge amount of cash after they were locking in long-term debt when rates were low. Okay, so basically what happened was, during that zero interest rate policy time, what they were able to do is take in long-term debt, right? And maybe they took more debt on than they actually needed, just to be financially wise, because they knew that zero interest rate policy and extremely low rates wouldn't last forever. And now that we have an inverted yield curve, what they can do is they can literally go to short-term treasuries, and get paid more on short-term treasuries with their cash, than what they have to pay on their long-term debt. Okay, so it's very simple concept. Not all companies are actually able to do things like this, and this is what has been largely driving some of the magnificent seven stocks up higher. Now, I also talked about how they have a great stock buyback program that's continued to push the stock higher because it's very attractive to investors. And was mentioning, if you basically take a look at the market cap and the share price on the same chart, that will demonstrate it to you. And then, a day or two later, Greg Gavin was out here, and he was explaining, do you know who's been the largest buyer of Apple shares? It's actually Apple itself. If you look at Apple's shares outstanding over time, this is just a simple 5-year chart, and it really goes and shows you guys how much, this buyback program is really affecting the price, right? And so this is something that, a lot of other companies wish that they could emulate and wish that they could replicate, but it's one of the things that truly makes Apple, the great stock that it's been, for a long time. Now, let's get into the meat and bones, right? I know you guys are very concerned about TLT. There's a lot of stuff all over the chart. It may look a little bit messy, but basically, what we've got right here, all right, is, we've got a nice little rounded bottom right here, okay? And we all love a nice round bottom, but, essentially what I've really been theorizing is that ultimately TLT is going to be range bound before we get some type of catalyst that's really going to shift the tone, okay? And the range for me has been around this 89.21 level down to about $82. It came down to 83. And you can see, we've started the downtrend, right? Continued that downtrend actually, and we did consolidate through this period here. And if we can really hold above 89.21, I do think there's a chance that TLT can go bullish, and really break out of this consolidation phase, right? Because there's 3 stages to a reversal. You have the downtrend, then you have box consolidation, and then you have the reversal itself. Okay. But these gaps down are what have me cautious, right? And, I was mentioning that when we were trading above here, said, hey, we do need to be a little bit cautious. We've got this gap down to fill. It can come down to fill that gap. I filled a good majority of that gap there. All right. We still have another gap down to fill. So, let's just say for some reason, right, and we do have the 20-year auction next week. I believe it's on the 20th. Let's say that auction goes bad and we start to see the bond market pull back and we start to see TLT pull back and it comes down to this $85 level to fill that gap. Well, that could, in a sense, actually end up being the handle for a cup and handle, right? We've already got a baseline cup right here forming. If we were to get some type of a pullback and find support within that range and then break out above that 89.21, that would be a very textbook and very clean 89.21. This is our 200-day moving average right here. And at which point it would start to look a little bit something like this and start to come down lower. And price could definitely break out to the upside off of that cup and handle and come up towards 96, 97, where that 200-day moving average most likely would be. If you take a look, we've got a nice gap up to fill right there, right? Now, there's actually tons of gaps up to fill on TLT, but at the moment, the gap right here to about 93, the gap right here to about 96, and then this other one here to about 97. Those are going to be the most important ones and closest ones to us that we want to pay attention to as traders. But we just need to be cautious of this one down here to about that $85 level. Okay, so another thing that really helped drive the rally here, okay, is if you take a look, we're making these lower lows on the price, but making these higher lows here on the RSI. This is a term known as bullish divergence, right? And we saw a nice rally off of that. And it's very possible we could getting some bull flag consolidation here if we were to just simply chop sideways, right? It appears that that's what we're getting here currently at the moment. is a strong flagpole to the upside, and now we're just dancing in between, consolidating ultimately before seeing where the next move is going to be. But you do want to be cautious. If we end up breaking this daily bullish divergence that we have right here, it could end up causing us to come back down lower to those potentially oversold levels that would coincide with us, at least coming down and filling that gap around the 85 level. So that's the main things I'm looking at on TLT. TNX is still pretty bullish. Okay. Now it is starting to break this channel. It's attempting to break this channel. It's been trading in a bullish channel ever since the banking crisis, right? And we topped out with our wave 5 of 3 here to the upside, and we were expecting this wave 4 pullback. We were looking for this gap fill here around 4.4 on the TNX. We're very, very close to getting that, right? We're just dancing right above it. But we need to keep in mind what the trend is overall, right? The trend has been very strong within this channel, and it's very possible that this thing can reverse back to the upside. Okay. And if it wants to do so, we could see the 10-year treasury back at 5% or even potentially higher than that. So you do want to be aware of that. Now, if you're a bull on TLT, this is what you're looking for. Okay. You're looking for the breakdown. 4.128 is going to be a pretty key level. Okay. And the reason being is because, this is an area where you can potentially bounce on the breakdown and then start trading back up within that range. If we do something like that, that's known as a look below and fail. It's going to be a bullish indicator and actually show you guys that TNX is actually more bullish than it is bearish. And that was a false breakout to the downside. Another reason why this 4.128 level is going to be so important is because look at our rising 200-day moving average. As this thing continues to rise and play out over time, it's going to gravitate closer and closer to that 4.128. It's also very common to get some type of a wave for retracement back to that 1.0 extension level. So, ultimately we'll see where yields are going to go here. All right. We're right on the verge of getting that breakdown that we want and getting that push up higher in things like TLT. But we'll have to see if we're actually going to get that. Okay. Now we do have to be mindful that we've got a gap up to fill now. Okay. So not only do we have this gap down that we're very close to, but let's say we come down, fill this gap again, get a look below and fail, and then come back up within this range and fill our gap up now just under 4.8 on the 10-year treasury. Okay, this is, these are all things that you want to be mindful of and use to help you navigate, the space whenever you're moving forward. That's going to be it for today's video. Smash the like button, subscribe to the channel, sign up for the Investment Intelligence newsletter using the link in the description below to get that free valuable finance content, to get those free trade ideas once or twice a week. And if you want more access to, all of the different charts and different trades that we're looking at, you guys can join the Discord, the Investment Intelligence Discord. There's a link in the description as well for that. It's very nice. Just started it about a month, maybe closer to 2 months now. So the community is still growing. You guys can be, one of the first 100 people in there and be able to say that you were there, before the community got very, very big.